Okay, let's dive right into this. Welcome to This Explainer. Today, we're going to completely demystify one of the most fascinating and, let's be real, probably the most misunderstood concepts in personal finance, building wealth through passive income. Look, if you're a focused learner trying to cut through all the internet noise to figure out the actual mechanics of making money without constantly trading your precious hours for dollars, well, you're in exactly the right place. We're going to break down the real, honest science of architecting wealth step by step.
Think of this agenda as our architect's blueprint for the day. We'll start by busting the big passive income myth, then explore capital-driven and effort-driven income streams. After that, we'll hit you with the honest truth and wrap up with the ultimate compound growth engine.
All right, Section 1, the passive income myth. Let's just rip the Band-Aid off and look at why this is arguably the single most misunderstood phrase in finance right now. Let me just ask you this straight up. Can you really make money while you sleep? I mean, we've all seen the flashy promises, right? The luxury cars, the influencers on a beach claiming they just hit a button and cash magically poured in. But since you're a smart learner, you probably already suspect there's a serious catch here.
Now, what's really interesting about this slide is the contrast. Social media sells us this wild myth that passive income equals free money, like it's generated out of thin air from a magical money tree. But the grounded reality? The reality is that passive income is actually just delayed effort. It's not magic at all. It's an economic mechanism where you do the heavy lifting up front, and the payoff, well, that happens later.
Let's bring reality into focus here with a concrete definition. True passive income actually exists on a spectrum. It demands a significant upfront investment of either money, time, or skill. The part that makes it passive is what happens after that initial push. It needs minimal ongoing effort to maintain. Because honestly, almost nothing is 100% passive. Even if you own dividend stocks or real estate, you're going to have to occasionally check in, even if it's just waking up at 2 a.m. to authorize a plumber to fix a leaky pipe.
So the crucial point is understanding these three core traits. 1, it demands that upfront capital, time, or skill. 2, it needs minimal ongoing maintenance. And 3, and this is literally the magic one, it generates money entirely independent of you trading your hours for a paycheck. This is how you successfully sever the tie between your time and your earning potential.
Moving right along to Section 2, capital-driven income streams. We're going to focus squarely on methods that require some serious financial capital right out of the gate.
Let's look at investment-based streams. You've got dividend stocks, where companies literally hand you a portion of their profits just for holding their stock. You've got bonds for fixed interest, REITs for totally hands-off rental income, and high-yield savings accounts. Check out that passivity level, though. It is the absolute highest. A diversified index fund is genuinely hands-off. But there's always a catch, right? The massive trade-off here is that they all mandate having cash to start. You absolutely need money to make this kind of money.
Staying with capital-driven streams for a second, let's talk physical real estate. Owning rental properties is an absolute classic wealth builder. But look at that passivity level. It's only semi-passive. Dealing with tenants, broken boilers, vacancies, that takes real effort. I mean, unless you hire a property manager, but that's going to eat right into your profits. That's exactly why real estate crowdfunding has exploded in popularity. It lets you pool your money with other people to invest in massive projects without the 2 a.m. phone calls. It's a much more accessible, hands-off alternative, though, yeah, it still requires high capital up front. Okay, Section 3, effort-driven income streams. Let's move to and see how this builds. What if you don't have thousands of dollars sitting around right now? Well, this is where you invest your time and skill instead. Consider digital and content-based income. Selling ebooks, templates, earning YouTube royalties, licensing your photography. The upfront work here is immense. It's entirely front-loaded. You might spend months, literally months, building an audience without seeing a single dime. But once you hit publish, the ongoing cost to duplicate a digital file is practically zero. You've basically created what we call an evergreen product that can pay out royalties for years after that initial hustle. Then we have business-based income. Think affiliate marketing, where you earn a commission recommending products, or print-on-demand dropshipping, where a third party handles all the manufacturing and shipping for your designs. Or even building an automated software app. Now, the effort to start these significantly higher. You still have to do marketing, you still handle customer service. It's essentially a semi-passive side hustle. But the scalability, wow, it is incredible. Because the internet has billions of users, an automated digital business can scale in ways a physical storefront just literally can't.
All right, Section 4, the honest truth. Let's pull back the curtain a bit and reveal the reality of how these streams are actually constructed by successful individuals over a lifetime.
Here is the absolute reality, plain and simple. Every single passive income idea out there requires money, time, or skill upfront. Usually it's a combination of them. There are absolutely zero magic shortcuts to building lasting wealth. If someone tells you there is, well, they're probably trying to sell you a course. You have to be willing to plant the seed today if you want to enjoy the shade tomorrow.
And this brilliantly illustrates the exact sequence most self-made individuals use to realistically build their passive income portfolios. Step 1, they save and invest their active income into genuinely passive vehicles, like dividend stocks or REITs. Step 2, they use their unique skills to build something once and sell it repeatedly, like a digital product. And step 3, they build a scalable, automated business. That is the realistic roadmap right there.
You know the genuine secret that most of those internet gurus won't tell you? It's this. Succeed at active income first. Excel at your day job. Crush it at your active, hands-on business. Earn that money through hard work, and then aggressively channel and redirect those hard-earned funds into the passive streams we just discussed. Think of your active income as the shovel you use to dig your passive income well.
Finally, we arrive at Section 5, the compound growth engine. Let's look at how passive income is fundamentally intertwined with the mechanics of long-term investing.
A lot of folks out there treat passive income like it's some sort of trendy new hack. But the truth is, passive income is the result of long-term investing. It's not some separate concept. If you build a portfolio of index funds consistently over decades, eventually it's going to generate enough dividends to represent highly meaningful, self-sustaining cash flow. It is really just a matter of giving it enough time to grow.
$1 million. It's the ultimate compounding story, right? Turning one single dollar into $1 million absolutely does not happen overnight. It requires patient building today to create effortless income tomorrow. Think of it like this. Every single dollar you invest into an asset today becomes a tiny employee working for you 24/7. And eventually, that dollar earns its own dollars, which then earn their own dollars. It's a massive snowball effect.
I want to leave you with this final provocative thought to wrap up everything we've explored in this explainer. There is no truly passive income. There's just income where the work happened earlier. So the question you've really got to ask yourself now is, are you willing to put in the work, the capital, or the skill today so that your future self can get paid tomorrow? Pick the path on the spectrum that matches your current resources, start architecting your wealth, and let compounding do the rest.
Welcome back to part 2 of our deep dive into the architecture of lasting passive income. So in part 1, we broke down the core categories, investments, real estate, digital products, business income. But here's the thing, knowing the categories is actually the easy part. In today's explainer, we're jumping right into the harsh reality of why so many people just completely give up on passive income before it even starts working.
Right, so why do these efforts fail so frequently? And why are they so often quietly sabotaged from the inside? The source material reveals something fascinating. Most people don't fail because they picked a bad idea. Not at all. They fail because they fundamentally misunderstand the timeline and the effort required. And that leads to a series of very specific, completely avoidable errors.
And that brings us to the passive income illusion. To really get this, we have to look at the very first major trap people fall into. We've got to totally shatter the illusion of what passive income actually looks like. Okay, so mistake number 1 is expecting immediate results and then quitting during the necessary, totally unpaid build-up phase. Honestly, the very name passive income is kind of a trap in itself, right? Because it tricks us into thinking money just appears out of nowhere with zero effort. The reality is that almost every single stream out there has a slow, unpaid build-up phase. You actually have to write the ebook, grow the audience, save the capital, or learn the skill. People bail during this phase because it doesn't feel passive yet. But here's the big secret. It isn't supposed to feel passive yet.
Now, onto the 5 mistakes that kill it. Mistake 1 was just the beginning. Let's look at the other 4 silent saboteurs that will literally kill your financial momentum.
Mistake number 2 is splitting your attention across way too many unfinished projects. It is so tempting to want it all. You read about dividend investing, so you start that. Then you launch a YouTube channel, you begin writing an ebook, and you start an affiliate blog literally all in the same week. The sources are absolutely clear on this. Splitting your attention across a bunch of unfinished projects means none of them get enough focused effort to actually pay off. 1 or 2 streams done well will always outperform 5 that are only started halfway.
Then we have mistake number 3, which is a massive budgeting trap. We heavily budget for the upfront work, but we're completely blindsided when our passive income requires ongoing maintenance months later. We schedule time for the sprint, but we totally forget about the marathon. Rental properties are going to need repairs. Digital products absolutely have to be updated as software changes. Content needs a refresh to stay relevant in search results. If you don't budget for this maintenance, you are going to be deeply frustrated when your income stream still demands a few hours of your time down the road.
Rounding out the trap, mistakes 4 and 5 are ignoring taxes and platform cuts and the disastrous error of quitting your job too soon. With mistake 4, people just forget that dividend income, rental income, and business income are usually taxable. Plus, marketplaces and ad networks take their cut. If you don't account for this upfront, your final numbers will be wildly disappointing. And mistake 5? Listen, passive income is meant to supplement your active income at first. Treating it as an immediate job replacement before it's proven is one of the most common and, frankly, costly mistakes you can possibly make. So, moving into a realistic way to start. Knowing what not to do is great, but we really need an action plan to avoid these traps. Here is the exact 5-step masterclass drawn right from our source material. This will practically guarantee you're building financial freedom without burning out. This isn't just theory. This is exactly how successful builders actually operate. Let's break these down. Step 1. Before jumping into any idea, you have to audit your resources. Figure out if your savings, your free time, or your specific skills should dictate your path. For instance, if you have some savings but zero free time, you should probably lean toward investment-based income. On the flip side, if you have a great skill and lots of free time but no capital, you should look squarely at digital products or content. Play to your current strengths. For step 2, pick just one single stream that matches your resources and fully commit to it for a solid 6 to 12 months before you even judge whether it's working. Remember mistake number 2? This is the antidote. Don't pick 5 things. Pick one single idea and give it at least half a year to a full year to actually breathe and grow. Step 3 is what prevents you from quitting early. It forces you to mentally and financially plan for a heavy build phase that is completely separate from the lighter maintenance phase. In the build phase, you're putting in massive upfront effort with little to no income. You just have to expect that. Then, and only then, do you graduate to the maintenance phase where the effort gets lighter and the income actually starts flowing. Knowing exactly which phase you're in is your absolute best defense against giving up. Finally, steps 4 and 5. Reinvest your early income to compound your results and only layer a new stream once the first one is perfectly stable. When that first stream finally makes a little money, don't just go spend it. Buy more index funds, create more content, buy more inventory. It compounds your results so much faster. And only when that first stream is truly stable should you use those profits to layer on a second idea. Next up, the slow then fast timeline. Understanding the phases is crucial, but mapping them to a real, predictable timeline is how you actually survive the journey. This timeline shows the gritty reality of the process. Months 0 to 6 are almost entirely input. This is where most people quit. It's practically the graveyard of passive income dreams. But if you push through to that 6 to 18-month window, you start seeing those small, albeit inconsistent wins. By year 2, assuming you built it well, you arrive at that coveted stage, consistent income with significantly less ongoing effort. And you know, this perfectly mirrors the pattern of compound investing. It proves that the unglamorous early period is the exact investment required to make your passive returns possible later on. It is a classic slow then fast trajectory. The magic at the end literally does not happen without the heavy lifting at the beginning. Which brings us to choosing when you work. The crucial point to take away from this explainer is a total shift in our perspective. Passive income isn't risk-free or effortless. It is simply delayed and concentrated effort that pays out over a longer timeline. If there is one thing you remember from the source material, let it be this. It is not about getting something for nothing. It's about front-loading your energy. You concentrate your effort now, so it pays you dividends over a much longer period with far less daily grind. Ultimately, our final takeaway is this exact thought. Building these streams is never about avoiding work entirely. It is about taking total control of exactly when that work happens. The most successful builders succeed because they pick one stream, budget for a real build phase, and reinvest early. They don't run from work, they command it on their own terms. So, knowing the reality of the timeline and the exact traps you absolutely must avoid, the only question remaining is when you will choose to start putting in your own upfront work. The blueprint is right here. The illusion is shattered. The timeline is laid out. So what's your first step going to be?